Hello, it's Kevin Prince from BMO Exchange Traded Funds. Thank you once again for joining us on the Market Insights webinar. Like in previous sessions, what our goal here today is really give you some insights to the marketplace and certainly some changing times out there and kind of give you those thoughts to help you think in your portfolio construction across the board. And again, like we had in previous times, I want to highlight that what we're going to do here is not give you direct advice and not give you specific recommendations, but really try to give you insights to market to help you guide in your overall portfolio construction. And I do want to thank the people that have taken the time and effort in sending us questions, because those questions help us drive our content again and again and again, as well as we take the time and effort of answering those questions at the end of the session. This particular session we're going to do is focus on dividends. And again, it's an outcome of the questions that came in on the respective surveys you answer to. So I'm happy to have a couple guests join me today. Alfred Lee from BMO Exchange Traded Funds. He's one of the portfolio managers of BMO Exchange Traded Funds. In addition, he does regular strategies for us, as well as actually was recently recognized as one of the ETF champions of the year. Congratulations, Alfred. And Mackenzie Box coming from our product team. So look forward to jumping into the topic of dividends and dividend considerations today. With that, before I do that, I always like to share some tools and some insights out there to really help you guide your ability to dive deep in what thoughts are on there on ETFs. So here's one tool I'm going to highlight for you. If you're looking at investing in American-based ETFs, so that's US-based ETF versus Canadian-based ETFs, there's a great tool. ETF.com is the website, sorry. And inside that tool, there's a comparison tool. Now, if you come to our previous webinars, you would have seen the comparison tool that we house on the BMO ETFs website, BMOETFs.com website. That does a great job of doing analytics of any Canadian ETF versus any Canadian ETF. In fact, you can even bring a Canadian mutual fund to that analytics too. But let's say you want to look at a US ETF and you want to do a US ETF side-by-side comparison. Well, take a look at ETF.com. Great tool on there to do a comparison of any US ETF versus any US ETF out there. And with that, let's get into the topic of dividends. Now, why do we get into the topic of dividends? Really, to give you some background, the key thought here is portfolios are changing in the construction. And it's really on you to think about the portfolio construction different than you did before. And really what we're just giving you here is, a sample of how you can reach different return expectations and different risk levels. And you see the asset mixes through the various pies across the board. And what you're really seeing is a very simple portfolio just 20 years ago, right? It's a lot more complicated now to get to a similar return expectation, and you're going to have to take on more risk to get there. So how do you work to mitigate that risk? And maybe dividends is one way to generate some income for you, plus work to mitigate the risk. Your portfolio is your portfolio, but really we're talking about portfolio construction is changing, and keep that in your consideration. So taking the focus on the topic of dividends, let me bring Alfred Lee into the conversation. Dividends become more and more popular. Why do you think dividends are becoming more and more popular as a solution set out there? Alfred?
That's a good question. I think, we've definitely seen the demand for dividends really pick up in the last 10 years. And I think it's really just twofold. I think as Canadian investors, we tend to be a lot more conservative in nature compared to, let's say, investors down in the US. Canadians as a whole tend to invest primarily in dividend paying stocks. One thing to keep in mind is that dividend paying stocks tend to be more mature companies. Compared to non-dividend paying stocks, which tend to be, for the most part, early stage growth companies that do not pay dividends. In addition to that, I also think we have an aging demographic, not only in Canada, but also globally as well. So there's definitely more of a need to generate income as well, as people are already in retirement or already nearing retirement as well. The challenge, however, is that this chart on page 6 is a good illustration of that. When you look at yield around the world, so when you look at bond yields, for example, both the bond yields in Canada and the US have come down significantly in the last 10 years. So I think, in the past where investors have relied on bonds to generate yield. Obviously now at this point, whether you're looking at government bonds or corporate bonds, the yields that you're getting or the coupons that you're receiving is a lot lower now. Obviously in the last 30 years, yields have come down significantly. For those of you that are old enough to remember, in the late 70s and early 80s, yields went up significantly to 18 to 20%. As the Fed chairman at that time, Paul Volcker, basically his mandate was to increase yield and basically squash inflation. And since that time, over the last 30 years, yields have been slowly compressing bit by bit, year over year. And one of the effects of that is essentially it's placed a big demand on yield, where dividend yields from. So for a lot of people that are looking for yield right now, for example, if you're looking at the traditional market cap weighted indices, the yield from a traditional market cap, whether you're looking at the S&P TSX or the S&P 500, it's just not generating enough yield for a lot of investors. So a lot of investors have gravitated to the equity side of their portfolio to generate that yield, but also have focused more on dividend paying stocks and also dividend paying ETFs as well.
Well, thanks for that, Alfred. I mean, really, the chart really shows also too, building that portfolio construction concept, that really things have changed. And you're right. I think people are looking for different ways of building portfolios, and that's where those dividend come in. Now, of course, part of dividends in the universe out there is, of course, dividend ETFs. Mackenzie, talk to us a bit about some background around dividend ETFs and what you're seeing in the marketplace around dividend-based ETFs.
Sure, and thanks, Kevin, and thanks everyone for joining. So first off, I think we'll just take a step back and really just define dividends. And as kind of Alfred alluded to, is generally dividends come from those well-known blue chip companies that are paying out income. And it is one of the most common approaches to investing, in particular in ETFs. There's many dividend-focused ETFs in Canada, but how they generate that yield is the key difference. So we have several different products that approach it differently. So when you are looking at these products, you really have to look under the hood and understand, how is it getting that yield and what's driving that. I included a quick screenshot here of some of the dividend-based ETFs in Canada, and currently there's over 15 billion in AUM, accounting for 11% market share. And this year alone, we've seen over 700 million in terms of flows into these products. And I think income is something investors always need, so it tends to always attract assets. And as Alfred had said, aging demographics, people are looking for income in their portfolio. So I think that's something that's always going to be top of mind for investors.
Thanks, Mackenzie. Dive into a little bit more for me, if you can, around dividends. Specifically, when you're looking at dividend ETFs, looking at yields, what's the primary reason why people are, I guess we know people are looking for higher yields, but, other things people look for dividend ETFs, a little bit less risk. Maybe walk us through kind of the different choices out there a bit.
Yeah, and I think, as I mentioned earlier, like how each product generates yield is different, and it's always important to make sure you understand if you're investing in a dividend or income-based product, that they're delivering that yields above the market. So, for example, here we have an example of our Canadian broad-based ETF, ZCN, which tracks the S&P TSX, our Canadian ETF, or dividend ETF, sorry, ZDV, and our low vol ETF, ZLB. And I just charted the yields against one another. And so for me, the first thing you look at for dividend-based product is delivering yield above the market. So that really tells you that you're investing in a true dividend product. And some dividend-based ETFs are structured differently and are weighted a certain way, which ultimately impacts the yield. So when you are looking at dividends in particular, you want to make sure that you're comparing it against the market and that you're actually getting the desired income that you're looking for.
Yeah, I have to agree. I mean, effectively, if you're going to deviate from the broad market, what's your objective, and is that actually meeting your objective across the board? Alfred, maybe you can talk to us a little bit more about the trade-offs when you're looking at, a dividend relative to other investments out there, and walk us through in those considerations.
Sure. So, as Mackenzie pointed out, there's a number of different ETFs that investors could invest in now. So I think traditionally, obviously ETFs have been gaining a lot of popularity in the last 10 to 15 years. In the beginning, however, most of the ETFs comprised mainly of traditional market cap weighted indices. So, while market cap weighted indices or traditional indexes were very effective for a lot of investors, one thing to keep in mind is that, investing is not a one size fits all strategy. And that's why we've seen, really just, the rise of these factor-based ETFs where, in my opinion, it's been one of the greatest innovations in the ETF space, not just in the past decade, but also the last, 30 years since ETFs came to the market as well. Factor-based investing, just to quickly summarize, instead of weighting companies by a traditional market cap where larger companies get more of a weighting, a factor-based ETF is essentially, focusing on stocks that essentially exhibit certain characteristics. So there's dividend factor ETFs, there's value factors, there's equality, volatility, so on and so forth. So meaning, with these factor-based ETFs, whatever that ETF is focused on, stocks that exhibit those characteristics are going to be given more prominence. So take, for example, if you are, a quality ETF, it's going to focus more on blue chips. A yield-weighted ETF or a yield-oriented ETF is going to focus more on dividend-paying stocks. So I think it's very important for investors to know that, there are trade-offs. When you tilt towards certain characteristics, you will likely be sacrificing others. So dividend-paying stocks, for example, focus more on more mature companies, so they tend to have less growth compared to early-stage growth and momentum stocks. Whereas quality stocks, on the other hand, focus more on blue chip stocks, and they tend to underperform when the market favors, smaller cap, riskier companies. But at the end of the day, I think those characteristics are the main objective that investors should be looking for. So if an investor is looking for yield, they should be focusing more on dividend-paying ETFs.
Thanks, Alfred. And and I appreciate the fact that you also did another chart for me. And I'm going to jump to that chart now too, because this kind of takes a look at the trade-offs of, some people look at volatility because, you want lower risk from dividends. And some people look at growth, and some people look at, of course, income. Maybe walk us through that trade-off a little bit more. And here's some performance plus the yield plus the volatility.
So the comparison between total returns and annualized volatility, you mean?
No, I'm just talking here in the chart wise, just highlighting, there's annualized returns. Let me just cover it off. But what we're really trying to highlight for everybody here in taking a view is we put together a quick little chart here, just kind of showing you when you look at your investment objectives across the board. Ultimately, think about that, as Alfred was saying, there is a performance objective, understand that. There's also a volatility objective, and that's a trade-off. You're going to get different volatilities relative to performance. And of course, yield is the other trade-off. So these are all the kind of things you look at: performance, volatility, and yield when you're looking at a dividend ETF, and a dividend ETF in context of all the other ETFs out there in the overall marketplace. Now, Alfred, maybe talk to us a little bit more. Oh, I'm hitting one too many buttons. I apologize. Alfred, talk to us a little bit more about the different types of dividend ETFs out there, or different types of dividend factors themselves, because you talked about the factors of your overall market, but with inside dividends, of course, there's factors too. Talk to us about that.
Yeah, so I think that's very key, right? So I think one thing that investors should note is that, just because a stock pays a dividend, not all dividends are created equally. So this is a good chart that illustrates that, where, there is a separation between, dividend growers, dividend payers, and dividend cutters as well. So just to summarize, dividend growers are essentially companies that have been growing their dividends. And, think about it where, if a company is growing their dividends, that typically means that, their business fundamentals are very strong, where they have strong cash flows, so they can increase their dividends. So typically what you'll find is that dividend growers tend to outperform, just because, they do have, they are in a position where, the business conditions for them are very good. So business is doing well. so they increased their dividends. Dividend payers, on the other hand, dividend payers are essentially any company that pays a dividend, whether they're increasing dividends or have a stable dividend or have been decreasing their dividends. Dividend cutters obviously are companies that have been cutting their dividends. So obviously a company that is cutting their dividends obviously tends to be companies that are falling into maybe a little bit of financial hardship. The business cycle is against them, so it's one way to kind of protect their own balance sheet. What they tend to do is cut their dividend, and obviously non-paying dividends typically are kind of higher growth early stage companies that could reinvest the cash into their own business rather than paying out a dividend. So there is a big difference between total returns. Obviously, dividend growers tend to be those companies that do have a stronger growth profile or business profile. So they tend to outperform over the long term. Another thing to keep in mind is that dividend stocks tend to outperform over the long term. One way to think about this is that if you compare a stock that has a 3% dividend compared to a stock that does not pay a dividend, one way to think about this is that every year that dividend paying stock is going to have a 3% head start compared to a company that does not pay a dividend. When you're looking at annualized volatility, one thing to keep in mind is that volatility for dividend growers tends to be lower. Again, because these are typically companies that have sustainable cash flows, tend to be in a good business position. Dividend cutters tend to have higher volatility because again, dividend cutters tend to be companies that are falling against financial hardship and are reducing their dividends as a result of that.
Thanks for that, Alfred. So Mackenzie, with the backdrop of the different types of dividends out there, I'm going to ask you to walk us through various different types of ETFs out there. And one of the things that I love about the ETF industry here in Canada is that it's expanding on a regular basis, and there's more and more choices coming to the marketplace. But when you think about the choices when it comes to dividend ETFs, what do people need to look at in that consideration of all those choices out there, based upon some of the concepts that Alfred just kind of highlighted again, because there are different types of dividends that these ETFs are focusing in on.
Yeah, and I think Alfred said it great, saying not all dividends are created equal. And I think this example of some of the dividend-based ETFs in Canada providing exposure to the Canadian market really speaks to that. And I've included a few different key metrics in this chart and just different ways that you can look at ETFs and analyzing them when you're looking at different products. So, just going across the board, some follow an index, some don't. So at BMO, we have a proprietary approach, and looking across the board, most do follow an index. Some are more yield weighted and some are market cap weighted. Some have additional screens, so they're screening for multiple things. Like, for example, at BMO, we look at a dividend growth rate, we use payout ratio, forward-looking consideration. So there's multiple levels, whereas some are simply just weighted by yield. And so it is really important when you're looking holistically at the universe, understanding how the ETF is constructed and what you're actually getting exposure to. And I think this really pulls across throughout some of these other metrics. So, AUM, the number of assets in the ETF, is also something you want to be mindful of. These are all ETFs that have been around for quite some time, so they all have very notable assets. And of course, fees is always something you want to be mindful of. But when you look at holdings and your top sector exposures, I think that's really interesting, because I think that gives you insight to, how concentrated is your portfolio, and what exactly are you getting exposure to, and how different are you from the broad market. So I think those are key points to look at. And then, of course, last but probably the most important when you're looking at dividends is yield. So just looking across the board here, the yields range from 3.7 to 5.9. And that's quite a variance when you're just looking at Canadian-based dividend companies. So you always want to make sure you're looking under the hood, really analyzing what the ETF is holding.
Thanks, Mackenzie. And let's take another lens too, not just Canadian based, but let's take the lens of the US market. Certainly some of the key factors. What else would you like to highlight when you look look at the US side across the board?
Yeah, I mean, I think dividends are extremely popular, you know, whether we do Canada, US, or international, the themes kind of carry across the board. But you do really want to dig into your yield and really look across, you know, how is it performing against some of the other ones? What's it yielding? What's it providing exposure to? How many holdings are? So, for example, looking at the US market, you know, holdings range from 75 to 212. That's a huge variance. And then looking again at 1.29 to, you know, almost 4%, it kind of makes you think, you know, why is this different, or what are these ETFs doing, and why are they so different, the results so different from one another? So, you know, make sure you kind of look at the holdings, look at your sector exposures, look at your yields, and understand how the ETF is constructed.
Exactly that. And then let's take a look a little bit about digging beneath the hood. I mean, one of the key things to think about is, you know, certainly in our industry, there's a lot of naming convention out there. We just already talked about different types of dividends. Maybe you can walk us through what to look for and even beyond the naming convention across the board, Mackenzie.
Yeah, so in this chart here, we kind of just graphed some of the examples in the last chart that we highlighted. So we have the BMO's US Dividend ETF, we included the Vanguard one, and then we also used some different other factors. So we also included quality, which Alfred alluded to earlier, and then a US quality dividend, just to see how the different ETFs play out against one another. And what's interesting is that if you look at, you know, the dividend-based ETF in the BMO one, which is your green line, you know, versus the Vanguard ETF, which is your blue line, you get quite a bit of variance. So it kind of makes you question, you know, what is this ETF providing exposure to? How is it weighted? How is it constructed? And is it really giving me the yield above the market that I need? So just be mindful of that when you're looking at these ETFs. The other thing I would also highlight is you want to make sure you're looking at total return. This here is an example of total return. So that's your price return and your dividend. Often things are reported in price return, so just want to make sure that you are looking at total return when you're analyzing these things.
Yeah, real good tip on total return. A lot of systems certainly only focus on price. You definitely want to make sure you're looking at price plus the dividend income coming in when you're looking at various dividend ETFs out there. Alfred, walk us through, Mackenzie mentioned a bit about the dividend ETF from BMO. Walk us through that proprietary process out there that BMO follows.
Sure. You know, I think Mackenzie raised a very good point where, you know, not all dividend strategies are constructed in the same manner. So the way we build our dividend strategies, we focus on a lot of the sustainability of those cash flows or dividends. So essentially what we do is we start with a large selection universe. So using Canadian dividends as an example, what we do is we start with, you know, the Canadian equity universe, so all primarily large cap equities. So that's our starting point. And then what we do is we screen for stocks that have had a growing dividend. So I highlighted the importance of dividend growers a couple slides ago. What we want to do is just focus on companies that have had either a growing dividend over the last 3 years, or have at least kept their dividends flat over the last 3 years. So I think, you know, what we're trying to do here is essentially focus on higher quality companies and companies that have been able to, you know, grow their dividends. So to focus on those companies that have, you know, a stronger underlying business fundamentals. However, you know, what we want to do is go one step beyond that as well. So we want to look at the sustainability of those dividends as well. So I think this is a very key metric in terms of, you know, how we screen for dividends, because what we're doing here is we want to screen out, you know, those companies that are potentially yield traps. So meaning, you know, a stock could have a very high dividend, but could be overpaying compared to their cash flow. So what we're doing here is we're looking for two indicators. We're looking for a backward-looking indicator and a forward-looking indicator as well. So the backward-looking, we're essentially looking for dividends paid over cash flows from operation. So we want to ensure that companies have the underlying cash flows to support those dividends. We also have a forward-looking one as well, so dividends over projected net income. So we want to ensure that, again, the projected net income is going to be enough to cover those dividends. So we want to, screen out those lower quality companies that, have a high dividend but can't afford to pay out those dividends. So essentially, screening out those potential yield traps. And then last but not least, what we do is we will weight the companies or the stocks in the portfolio using a yield weight. So this is very key. I mean, the sustainability score is very key in terms of allowing us to do the yield weight. If we were to do a yield weight without that sustainability screen, we potentially could be overweighting those companies that could potentially be yield traps. So that sustainability metric or that screening is very key in terms of allowing us to weight the companies by yield.
Thanks for that, Alfred. Now, the other thing too is to quickly highlight, we talked about yield a bunch of times. When you're looking at yield and doing your own considerations around yield, a key thing for you to think about is that the current yield in the portfolio, or is it backwards looking? A lot of times there'll be a kind of more of a trailing yield of a portfolio versus a kind of more of a forward looking, which is a current yield. Key difference between the two, because backwards is backwards and forwards is forwards. So think about that. What is that yield number you're looking at? And then of course, when you're comparing one to the other one, you want to make sure whatever you're doing has the same kind of viewpoint, current, or is it backwards looking, so you can do that fair comparison. The other thing I'll quickly highlight too is make sure if you can take a look underneath the hood of that ETF itself and see if it's actually generating the income to pay out that yield. And we're giving you one example here of XTR here, for example. The yield's about a little over 5 there, I guess, and the underlying, we can see it clearly, is lower than that. So you want to look at that. It's not just the yield number. Is it current or backwards looking? And then if you can, take a look underneath the hood itself. Is it generating the yield to pay it out on a regular basis? Mackenzie, maybe you can talk to us a little bit about portfolio construction. I know we have some kind of growing asset allocation ETFs that grow, that is, but let's say we want to have more of a dividend focus to it. Maybe give us some thoughts in around that.
Sure, and great example. I used ZGrow kind of as my base and essentially substituted in some of the core broad-based ETFs for dividend exposures. So what you're seeing here is exposure to the Canadian dividend ETF, ZDV, ZDY, which is our US dividend ETF, and ZDI, which is our international dividend ETF, added with broad fixed income exposure, ZAG, and then getting more growth from EM through our ZEM ticker. So I've just included a quick snapshot using our ETF tools on our website of the portfolio. If you are looking to add in income to your portfolio while also still getting growth, this is kind of, just an idea just to show you how it kind of plays out, adding your yield. So here we show a 12-month trailing yield of 4.24%, while also delivering meaningful returns too. So if you're looking to add it to your portfolio, you could add dividends to growth. You can add them wherever it's suited, but definitely a good way to pick up some yield in your portfolio.
Thanks, Mackenzie. And I guess just some ideas across the board for portfolio construction out there. The other, of course, and last thing for considerations out there, tax is certainly a consideration in investing, absolutely these days. You think about Canadian dividends, you get that dividend gross up aspect. You think about international dividends, well, there's not the dividend gross up. It's of course income to everybody. We know that already. But the dividend gross up isn't what it used to be these days. So, those are considerations there. If you're looking for tax information, take a look at the respective ETF companies' websites. Generally, what you'll find on them is they'll give you detailed tax factors themselves per each individual ETF. It will take a little more work to dig at that, but that information is also available for you to do considerations with. And with that, let's shift gears now and let's cover some of the key questions that came in. Today, amazing day in regards towards the U.S. market, and of course the election and the news that came out around Trump. Alfred, let me turn to you. Next month, U.S. election. What sectors do you think are going to do a little bit better? And give us some insights and your thoughts around that. Now, I will give you a quick tip as an audience here. Next week, we're going to have a whole session focused in on the U.S. elections itself. So, Alfred might be a little bit tight, but we're going to spend a lot more time on this next week too. Alfred?
Sure. So I think there's a couple ways to kind of unpack this question. I think over the short term, obviously volatility is anticipated to pick up as there's a lot of uncertainty around not just the U.S. presidential elections, but also coronavirus as well. But in terms of sectors, in terms of the equity space, utilities would be one sector that I would say is well positioned for the volatility. One way to think about utilities is essentially it's almost like fixed income where there is a duration aspect to it. When interest rates tend to go down, that typically benefits utilities. So typically when equity market volatility rises, we typically have interest rates go down and the yield curve typically flattens as well. So that's going to tend to benefit utilities. Thinking beyond just sectors, however, one way to hedge against potential volatility is using low volatility strategies, which essentially overweights those companies that tend to have tend to be less volatile than the market as a whole. Covered call strategies is also another way to play it, where if volatility is anticipated to increase, then obviously from a covered call writing strategy, higher volatility essentially means that you're collecting more premiums from those call options that we are writing. So that's one way to use volatility and have it work for you rather than against you. On the fixed income side, I would say long duration bonds is an easy way to play this. Similar to utilities, long duration bonds tend to outperform during market turmoil. So things like long federal bonds like our ZFL or long U.S. Treasuries like ZTL, that's a good way to hedge out the volatility from the equity side of your portfolio.
Thanks for that, Alfred. And I'm actually stay with you a second too, Alfred. Gold's actually taken a little bit of a hit in the last little while. Maybe you can give us some background, what you're seeing in that marketplace, and give us some perspective, I guess, a little more than that.
Sure. So, one way to think about gold is that a lot of people think gold is a hedge against macroeconomic uncertainty, which it is. But gold is essentially a hedge for three things. So there's macroeconomic uncertainty, there's U.S. dollar weakness, and it's also a hedge against potential inflation as well. So right now, why we see gold selling off right now is because the U.S. dollar is strengthened. So if you look at the U.S. dollar index, which is an index of the U.S. dollar relative to 6 other currencies, that's up. The U.S. dollar index is essentially up 1.9% in September. This is a result of the risk-off sentiment that we've seen in September. Typically, when you have a risk-off scenario, U.S. dollars tend to strengthen. So as a result of that, a lot of people that have been buying gold, gold tends to be, as I mentioned, a hedge against U.S. dollar weakness. A lot of people have been buying gold over the last 6 months since coronavirus broke out because they're using gold as a hedge against potential currency debasement. So over the last couple of weeks, what we've been seeing is a lot of people taking profits on gold, and that's why we've seen gold drop over the last couple of weeks. So the question states that the ETF dropped 12%. So I'm guessing that it is a gold-related or gold company-related ETF rather than a gold bullion ETF. One thing to keep in mind is that with the gold company ETF, they tend to be even more leveraged towards gold prices compared to spot gold prices alone.
Well, thanks for that, Alfred. Always appreciate your insights. And let me close off with the last question, still staying with you. Markets are changing. People are feeling that markets might be changing here. So looking at the short positions out there, and maybe give us some background on different ways of shorting ETFs in the marketplace, or participating in the downside of the marketplace if people want to do that.
Yeah, so I would say there's a number of ways of doing this. I would say there's, 4 ways of doing it. You could go out and short the ETF. So if you want to short the NASDAQ or the S&P 500, you could go out and short, ZQQ or ZSP. One thing that investors have to consider is that there are borrowing costs when they short an ETF or any stock in general. The other option would be using an inverse ETF. So we don't have any inverse ETFs at BMO, but for example, Horizons has, the HIU, which inverses the S&P 500. The fees tend to be a little bit higher at 1.4%, I believe. But keep in mind that these tend to be shorter term holdings, whereas that 1.4% is an annualized fee. One thing to keep in mind also is that with an inverse ETF, you will have to rebalance that position from time to time. So for example, if you hold the S&P 500, then you want to use an inverse ETF to have a hedge ratio of one times. As the S&P 500 falls and as that inverse ETF gains, you're going to be overhedged. So you have to rebalance it up every once in a while in order to maintain that hedge ratio. Put options on an ETF is a third way of doing it. So you could always buy a put on an ETF. Keep in mind that not all ETFs have listed options, however. And the last way of hedging equity market volatility, as I alluded to in the past, is long-term government bonds. Long-term government bonds tend to have a natural inverse correlation to stock markets, meaning that when stock markets tend to go down, long duration bonds tend to outperform. It's not a perfect inverse correlation, so that's one thing to keep in mind. But that's a natural way of holding a long-term core position in your portfolio, but at the same time offset that potential equity market volatility as well.
Thanks for that, Albert. Also a good point for diversification, fixed income and equities. Good diversification. All right, that's all the time we're going to have today. I'm going to thank everyone for joining us, and I'm going to thank you for your questions. One quick highlight for next week. We're going to spend the time and talk a little bit more about the U.S. election and positioning around different scenarios around the U.S. election, different considerations around that across the board. So we look forward to having you join us next week, 1 o'clock, same time, same location. Thank you so much. Have yourself a good week ahead. Cheers.